3 quality stocks to buy near their 52-week low. This is a video that I do every Saturday when I go on any screener. I use Fiscal.AI and I put up stocks trading near 10% of their 52-week low. And I always find some amazing companies like Berkshire Hathaway, Eli Lilly, Salesforce, United Health, ISRG, which is robotics and medical. And I'm going to do a video on it hopefully next week. Adobe, UNP, Palo Alto with cybersecurity. So you could find a lot of interesting stocks trading at 52-week low. And this is something that I do every Saturday, and I find ideas, and I'm going to share 3 stocks that I'm going to talk about today. I believe some of them are getting interesting, and I'm going to give you my opinion if I believe they're presenting great buying opportunities or not. And I really hope you enjoy it as always. Now, the first one was actually a highly requested stock, so I have to talk about this one. And this one is CRM, which is Salesforce. Salesforce is down 27% year to date, has pretty much gone nowhere over the last year. It's actually a great company, Salesforce. They've been growing really well, 8% in revenues. They have a lot of subscription-based revenues, which is up 8% year on year. I remember the company when they overpaid for a chat app called Slack or whatever back in 2018 or 2019, and they just overpaid for the acquisition. So they're very well known for kind of overpaying for acquisitions, but it's a good company in general, very smart management team. It's getting a little bit too big. The multiple got a massive contraction. It's now trading at 20 times earnings. The company used to trade at 50 and 60 and 70 times earnings, now trading at 20 times earnings for a company like Salesforce. Now, the main reason why it got to 20 times earnings is because they're facing massive deceleration in revenue growth. The company used to grow 25, 26% in revenues, even 34% in revenues at some point. Now they're growing 7% in revenues, and revenue growth is expected to decline to 3% growth and 1.5% in Q4 of 2025. So the revenue growth is pretty much dead. The company is getting too big. They're facing a lot of competition, and they're just not growing as much as they used to. And this is the worst thing a growth company could face like CRM. And this is why the multiple has contracted. And I believe it's well deserved for the multiple of CRM to contract to this point. Now, the company is still looking for inorganic ways to start growing revenues, and they're going to acquire a company called Informatica, which is growing revenues like 3.9%, but then they have subscription, cloud-based subscription revenues growing 30%. And actually, they're going to pay a fair multiple for this one, which I'm surprised because Salesforce is not well known for paying fair multiples for a lot of those acquisitions. But I like these acquisitions. And this is what the company is trying to do for them to get back on some kind of growth. Now, for me to value the company, I would prefer to look at free cash flow. And the main reason why we're looking at free cash flow is because CRM has a lot of stock-based compensation, which normally is an expense and we have to take it out. But then they have a lot of depreciation and amortization, which is not an actual cash expense, and we have to add it back. So they're pretty much equal each other. And I believe free cash flow is a better metric for CRM than using net income or using PE to try to value the stock. Now, if I look at free cash flow for CRM, it's also been decelerating in terms of growth from 50%, 30%, 11%, 7% growth expected next year, and maybe 12%. So around, maybe it could settle down around 11, 12% growth for CRM. CRM right now is trading around 16 times free cash flow, price to free cash flow 16 times. And if it's going to grow 11, 12% a year, this is not even a one-time price to free cash flow growth. So this is like 1.5 times. So for me personally, looking at rough numbers, I'm not doing a deep dive in this video, CRM isn't really attractive. I mean, if I look at it, 16 times free cash flow, growing free cash flow, maybe 10%, 11%, 12%, I could see a 12, 13, 14% annual return. I don't believe CRM will provide life-changing gains unless they do some kind of crazy acquisitions and they get back to massive growth and it gets an expansion to 25 times free cash flow. But this is not something that I'm personally willing to bet on. I think on the low end, I could see 12, 13, 14% with CRM, and it could potentially be looking attractive. But I believe there's way better setups in the market. And to me, CRM, you could say it looks good, but to me, it's not the best setup in the market. And I've been saying it for a while. that it's some kind of a trap because you look at it, it looks cheap, it looks undervalued, but revenue growth has been decelerating. It will likely continue to decelerate. The company is too big, there's a lot of competition, and they're going to have to keep finding those acquisitions, and there's only so many they can find for the right price without overpaying. So for me, I don't really like CRM, and if I had to put up a annual return on it, I would say 12, 13%, maybe 15, 16% would be a stretch, but I think there's way better opportunities in this market. Now, the second one is Pepsi. Pepsi, I talked about it many times. It's actually starting to play out. The stock is up 11% from the low, and I'm seeing a lot of improvements with Pepsi. Pepsi does not need an introduction. They own many brands that you're familiar with, other than just the Pepsi brand and other and Gatorade and others. They own Lay's, Doritos, Cheetos, and Sabra, hummus, and so many different snacks and so many different things that you most likely know. The company did really well on earnings, massive beat, 212 versus $2.03 expected. They also did a very good beat on revenues. Now, as you could tell from this chart, Pepsi has been experiencing a slowdown in organic volume for a while. So if you look at their volumes alone without pricing, they've been facing -2, -3% in volumes as we're having lower soda consumption and snack consumption in the United States and around the world. You can blame it on Ozempic, you can blame it on better diets, which is actually great for the population, but they've been facing declines in organic volumes. Now, Pepsi has been offsetting it by raising prices, and they have the pricing power to offset it. They can raise prices 15% when we have inflation, and lately they've been raising them by 4% to offset the 1.5% decline in organic volume. So the company has a lot of pricing power. They've been doing it for 3 years, and I believe they can do it for the next 3, 4, 5, 6 years minimum. And it's just amazing. And by the way, I'm using Fiscal.AI to come up with all those charts. No other company has such data. So if you want to try it out, they give you 2 weeks of free access if you want to use my link in the description. But if I look at Pepsi, Pepsi is still trading at 17 times forward earnings. The average is 22 times. It's trading at 17 times. The bottom could potentially be in my opinion. It's looking very, very interesting. But in additional to a potential multiple reversion to the mean from 17 times back to 20, 21 times, you're also getting a dividend. This is a glitch, but the dividend is actually around 4%. So you're getting a 4% dividend. The dividend is covered. It's not the best coverage ever, but now they're going to have around 7.8 billion of free cash flow. Last year they paid 7.3 billion in dividends. So this is a dividend that is well covered. They've been paying it for like 28 years, and they will likely continue to pay it. Next year's free cash flow is expected to expand to $9.7 billion due to a lot of non-recurring items. They had a lot of changes in net working capital, which is going to be adjusted for, and it's going to be around 9.7 billion. This would be a massive difference between the dividends paid and free cash flow. So I don't believe Pepsi will cut the free cash flow anytime soon. So you're getting 3 things with Pepsi. You're getting a potential multiple expansion back to the average of 21, 22 times from 17 times. You're getting around a 4% dividend, and you're getting earnings per share growth, which is a guidance is high single digits. So 8% earnings per share growth, 4% dividend. This is maybe around a 12% annual return, and you get the potential of a multiple expansion, could be 13, 14, 15%. With the setups that I'm seeing with Pepsi, I think Pepsi personally is presenting a very interesting setup, one of the best in the market. The stock was hated. It's been flat for the last 5 years. That was another one of those high quality companies and best dividend payers, recession-proof stock that people were dying to own. Now, no one wants it. And Pepsi has proven themselves that they can actually grow their revenues, and they can offset the declines in volume by raising prices. They have done it quarter over quarter, and this is more sustainable than people believe. And I believe it will be sustainable for the next 3, 5, 6, even 7, even 10 years potentially, as the pricing power that this company has is much more than Procter & Gamble, much more than any other company in the stock market. So I like Pepsi very much, and I think they're doing really well. Now, the last one, which I did a video on, and it hasn't been playing out, is CNI, Canadian National Railway. The stock has now been down 7.5% over the last 5 years. They're not really doing well at all. CNI is a railroad that connects Canada to the United States, all the way down to New Orleans and Mobile, Alabama, and it goes all the way up into Winnipeg and in many places in Canada. And it's a very well-known railroad. It has performed really well over the years, and lately it has been struggling mainly due to the tariffs. And the tariffs have been affecting this railroad, and it has been affecting other railroad companies, but especially CNI. CNI has been getting affected very, very much. Now, this quarter has given us a deeper look on what kind of industries are being affected by the tariffs. The biggest one is automotive. Automotive is way down for Canadian National Railway. The second one that is down is forest products. And the third one is metal and mining. Those are the three that they mentioned: metal and mining, forest product, and automotive. Now, if we look at their mix, automotive is only 6% of total revenues. So this is not a big impact at all. If we look at forest product is 12%. So this is 18%. Metal and mining is 12%. So this is around 30%. So 30% of their revenues is being affected by the tariffs. The other 70% is for Canadian exports outside the United States, is for domestic things in the United States or domestic supply chains in Canada. So it's not too exposed to tariffs, but the 30% of their revenues is exposed to tariffs, and it's hurting the business so much that they only grew 2% in earnings per share. This is a company that used to grow 10, 11, sometimes 15% in earnings per share. In Q2, they only grew 2%. And this is very concerning for a company like Canadian National Railway, and it concerns them so much that they had to lower their outlook for 2025, and they lowered it to mid to high single digits versus the prior outlook of 10 to 15% growth. So it was 15%, now it's like 5, 6, 7, 8%. They pretty much cut it in half. And they had an outlook to grow, I believe, 10, 12% for 2025, 2026. Now they removed the outlook. So we don't know how the future is going to look like for Canadian National Railway. Okay. Now, if I look at the companies in terms of what I'm getting with it, I'm getting a dividend. The dividend is well covered. It's 2.79%. This is one of the highest dividends the Canadian National Railway has had in a while. And the dividend is well covered because the free cash flow yield is 4.6%. The dividend is 2.79. So this is almost a 50% payout ratio. They're not going to cut the dividend anytime soon. So I'm getting a 2.79% dividend. I don't believe the growth will be 10-15% if I had to bet. I think over the long term, they can potentially grow high single digits, just like they're going to grow in 2025. So maybe the growth could be 7-8%. So if they grow 7, let's say 8% in earnings per share instead of 15% like they wanted to, and they have that 3% dividend, this is like a 10-11% annual return. And the company is trading at a very discounted multiple of 16 times, as low as it was trading at in 2019. It pretty much never traded at 16 times, only 1 or 2 times since the data that I have since 2015. So when I look at CNI, I see a lot of uncertainty, but I see a great company with a good balance sheet, with a good free cash flow yield, with a good buyback program. They buy back a lot of stock. And to me, the stock is looking interesting. There's a lot of uncertainty, but I think a lot of this uncertainty is getting priced in. This railroad is not going anywhere, and the United States is still going to depend on Canada for many different things. So for me, I'm not seeing this railroad going away anytime soon. They're not going to build another one. It's always going to be here. It's just in terms of where the growth will settle down and where those tariffs will settle down. If there's any kind of tariff deal with the United States, the stock is going to bottom out and it's going to go up like never before. So I see a good setup with CNI. But if I had to start a position, I would be careful, as this is just looking bad, and I would just dollar cost average into the stock. But that's what I'm seeing with CNI. I like it very much. I like Pepsi the most, still my favorite. CRM, I mean, it's not really my favorite. I think there's way better opportunities in the market. And that's just my opinion for today, not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.